Hi, I'm making this video because some friends have asked me to put my thoughts down on what I feel may happen to the property market in the UK during and following the Covid-19 crisis. Well, obviously, one of the key components of all of our lives is needing to live in shelter. We have a requirement to live in a home, to live somewhere that protects us from everything the world has to throw at us. So we are looking for something that we can use for a reason, to provide shelter. Therefore, any property to us personally has a use value. In order to obtain that item, for us to use and extract its value, we have to go to the market to acquire it. And at the market, all those items that are available for us to acquire have an exchange value. That is how much currency you'll need to part with in order to obtain it, what it is you'll need to give in exchange for it. So those are our two markers. Economically, the use value is best expressed as being in proportion to the income of the person who's likely to be living in it. So historically, the average price of a house in the UK tracked the average income of somebody in the UK by about 4 or 5 times historically. And if you think about it, that's how mortgages always used to be given out, based on 3.5 times demonstrable income and the likelihood of that income continuing. Because that was the use value of a home for somebody who needed or wanted to live in it. And the use value, the exchange value of the house would be proportionate to what somebody was likely to be able to give in return for it. And that's how we have it really for pretty much most of the 20th century in the UK. In fact, from when records really begin in the 1930s all the way up to 2000. Everything is marked to market based on its use value, which is what is the person who is likely to buy that property because of its location, for example, what are they likely to be earning? And so everything then sort of tracks on that, and we say 4 to 5 times average earnings is the long-term mean, the long-term average. What's happened since 2000 is that the factor that most influences the exchange value of a property has significantly increased in effect. Now, the factor that most affects the exchange value of a property is not its location, but how much a bank is willing to lend somebody to buy it. If a bank is not willing to lend someone money to buy a house, is not willing to lend anyone money to buy a particular house, that house isn't going to go for the price that it's being asked for. It will come down. So the more money that banks lend to people, are willing to lend to people, the more house prices increase. This creates a commodity market in the housing sector, because if you've got a commodity that's increasing in value by 15% every year, that's a very attractive investment for people looking to grow their capital. And so that kind of growth rate attracts significant foreign capital investment for people not looking for the use value of a house, i.e. they want to emigrate to the UK and move their family with them, but they're looking to speculate on the exchange value of the property increasing. And frequently we've seen foreign investors buy property that isn't even built yet, but they have the option to buy, and they buy that option and can even trade it for a higher price before the property is even built. This has been going on for some time, for most of the last couple of decades. And if you think about it, if you can borrow money from a bank in another country at 5 or 6%, and then buy a property, a commodity that is increasing in value at 15%, you don't need to be an economics wizard to work out where you make your profit. You don't ever need to move in to the property. It's not about buying to let, although some investors have, just because of the sheer scale of their property investment portfolio, have decided, well, we might as well work some of these properties and sweat those assets, i.e. lend them out, rent them out to people on corporate lets. There has been a degree of that, but that's not been the main function. The main function has simply been to invest in an asset that is significantly appreciating in value, because 15% is a pretty good return. Okay, so what happens now post Covid-19? Well, it's unlikely that the UK property market will continue to grow at 15%, largely because there's going to be a lot of unemployment, there's going to be a lot of shock, and nobody's anticipating an easy landing if we go back, when we go back to that ghastly place where we were. Nobody's predicting a soft landing. Therefore, you certainly are not going to see continued 15% annual growth in UK property prices. It's the absence of that guarantee or strong indicator that is going to cause the property market to crash. Because once your commodity is no longer appreciating in value at 15%, is now potentially and increasingly and more likely now depreciating in value, as a good investor, you will look to sell as quickly as possible, particularly when you know, because you're an informed investor, where the bottom is of that and how far things have to fall. Now, this is crucial because of the way that the banks engaged in more or less unrestricted lending practices from 2000 onwards. By 2007 in the UK, the average house in the UK was worth 11 times the average income in the UK. After the 2008 crash, that did drop to about 7 times, but then it recovered and has been hovering somewhere about 8 to 9 times average income. Now, that's its use value expressed in economic terms. What is that house worth to the kind of person who's going to need to live in it or want to live in it? But look at that figure, that's 9, 10 times average income. So that's obviously an indication of a bubble. Because the long-term average is 4 to 5 times income. So you just, if you want to know the definition of a bubble, it's when something gets artificially inflated by definable means and goes way above its long-term average. After this crisis, banks are going to be severely restricting how much money they lend. All credit is based on your future earnings. A bank isn't going to lend unless they can be absolutely assured that they're going to get the interest they want from your future earnings. So banks aren't going to be lending any money to UK citizens who either don't have a job or who are in a very precarious employment situation. Foreign investors are going to rapidly start selling. They want to withdraw. There may be some investors who say, no, this is going to go down so far, it's worth just mothballing the whole thing and riding the storm out, so they won't sell. But others will say no, they were over leveraged anyway. They've got to meet their margin calls. Remember, a lot of them borrowed money in their home nations to invest in the UK property market, so they will have to meet those debts, which means they have to sell the properties before they decline below how much they have borrowed to buy them. And if there's any risk of that, they must sell, so they can't afford to mothball. Okay, so that's where you're going to get two significant pressures. The two major pressures that inflated the UK property bubble to what it became have now been eliminated. Banks are not going to be lending freely, and foreign investors are not going to see the UK residential property market as a good investment. That's obviously going to cause downward pressure. That cascades very, very rapidly out through the system as people start slipping into negative equity or are afraid of slipping into negative equity, particularly those people who have taken out subsequent mortgages and used the equity in their homes in the difference between the value of their mortgage and the exchange value of their homes, to increase their leverage, or the leverage on their property. So that will increase and that will accelerate things, and you'll see things going rapidly south. Final wrapper on the whole show is obviously now a massive repurposing and redefining of what we use cities for. Clearly cities are a health hazard. Clearly it's not much fun getting everybody into cattle trucks every morning and every evening. And in the wake of Covid-19 and any future similar pandemics, that kind of concentrated human activity is going to be seen to be highly risky. And so therefore, because of the liabilities that will come with high risk, likely to be discontinued, which means you have a lot less dependence on cities, which means you have a lot more commercial space now available for repurposing as residential accommodation. So I think those three factors are really now what should bring what has been an unhealthy and largely ill-informed obsession with residential property prices in the UK to an end.